I'm Mark Simpson. In my book, Excellent Investing, I describe practical ways that you can build a better portfolio by applying the principles of psychology and behavioral economics to portfolio construction. Today, I'm going to use the same concepts and describe how you can apply them to improve your stock analysis. Right, kicking it off, researching a potential investment is all about obtaining and processing the right information to make a buy, sell, or hold decision. This is how we often think about that process of stock research, consciously or subconsciously. I've called it the logic, and the inverted commas are because maybe not all of this reasoning is actually logical. So we often think that market's competitive. That's great. I agree with that. That the returns go to those with a competitive advantage. So yes, that's very true, I believe. And that knowing more than the market is an advantage. And again, I believe it is. However, we often then make a further sort of step that may not be logically sound, which is, therefore, the more knowledge I know about a company, the greater my returns will be by investing in it. And we often make a similar mistake, by applying the same logic to other people or the research of others. Let's take a theoretical investor, Joe. So imagine that Joe, seems to know pretty much everything about a potential investment. Joe claims that he has good investment returns. And when we question Joe on his particular company, his favorite company, he seems to know everything about it. He's met the management, he's read the trade press. He really is an expert in this company. And it's very hard not to then logically follow that with, well, if Joe knows a lot about this company, then I should follow him and invest in this company. So what's wrong with this logic? Well, it's problematic because our brains don't always work the way we expect them to when information gathering. So more information is not always better, and how you conduct your stock research often matters as much as the amount of research you actually do. I'm going to start by explaining why is this the case, and then share some practical ways we can overcome these challenges and hopefully be better stock researchers. So the first problem is that often greater knowledge leads to greater overconfidence. And for this, I turn to a classic study by a guy called Stuart Oskamp, who did this way back when in 1965. He was a psychologist, and he was asking other psychologists to assess the personality of patients from their case files. But rather than just giving the doctors the whole case files, he gave them incremental amounts of information. So he started with some very basic information, and in 4 steps worked up to giving them the whole file. And we can see the blue line on the graph here represents the accuracy of those assessments. It seems that doing personality assessments is quite a difficult task because, at the start, they were only 26% accurate. And even at the end, they only had risen to about 28% accurate. However, the problem arises when we look about how confident those doctors were in their assessment. They started off just 33% confident, but with the addition of more and more information, they actually rose to become 53% confident. So what we see here is that in complex situations, increasing our knowledge often increases our confidence far more than it actually increases our accuracy. They started off about 7% overconfident. They finished up about 25% overconfident, purely from the addition of more information. And this is dangerous to our investing portfolios because we often use our confidence level to position size. So we will have more in stocks where we're more confident that we know more, and appear to be better investments because of our increased knowledge, and less where we're less confident. But what this graph from this study shows is the relationship between accuracy and confidence is not always there. The second problem we have is that we often suffer from something called confirmation bias. We have a tendency to seek out information that confirms our prior held beliefs and then ignore or downplay information that contradicts them. So for example, if you're already bullish about a stock, you'll choose to only read bullish articles or posts. You just simply will ignore anything that's bearish research on that particular stock. You see this a lot in how we curate our Twitter feeds. Often we will like, share, and follow people who have similar beliefs to us, and we'll block, ignore, don't follow, don't retweet people we disagree with, no matter how good their reasoned argument is. And this means the way we go about increasing our knowledge tends to pre-confirm what we already believe or what we've already decided. And knowing about confirmation bias isn't a particularly good way of overcoming it either. You would think that academics who research confirmation bias would be not particularly prone to the bias. Their knowledge about it would mean that they would be very cautious about it. However, some other clever academics did some research into confirmation bias within the academic research of confirmation bias, and found that those researchers did indeed suffer from confirmation bias. So it's likely that we do the same in our investment analysis. The third problem is that information order matters as well. We suffer from, again, a bias, information order bias, and we place more weight on the first information we receive. So if the first thing we read is a positive broker's note on a stock, we're more likely to be bullish. Equally, if the first thing we read was a short report from a hedge fund, we're likely to be more bearish on that stock. And combined with confirmation bias, we will be slow to update our views. You see this in elections as well. So in elections, if we have limited information about candidates, we also tend to vote for the person that appears first on the ballot. So this is quite a ubiquitous problem. And it's made worse because we default to believing statements are true. And Daniel Gilbert found this in his research. We like to think that we hear something, we vet it, we consider it, and then we decide whether it's true or not. But instead it appears that we hear something, we immediately believe it, and then we decide to vet it later, and sometimes not at all. This is why you get things, urban myths, things like carrots help us see in the dark, or there's 7 dog years to a human year. We believe these, and we've taken these things on board despite there being no evidence behind them. We've simply heard them, believed them, and not bothered to vet them because they've sounded believable. Fourth problem that we get is something called the power of public commitment. We have a strong desire to appear consistent to prior statements we make. And this is a very powerful and pervasive motivator for good or even for bad. Robert Cialdini, in his book Influence, gives us a particular insidious example of the power of public commitment. In the Korean War, American prisoners of war were sent to either a Chinese or a North Korean POW camp. Compared to the incredibly harsh conditions of the Korean camps, the Chinese ones were not the most brutal, but they were the most effective at gaining compliance. There were very few breakouts at these camps, and POWs often turned each other in for very minor rewards. How did the Chinese do this? Well, they used the power of public commitment, and particularly the desire to be consistent to that. They started off by interviewing prisoners and asking them if they thought America was perfect. Of course, most prisoners would say, of course not, America's not perfect. But then the Chinese would ask the prisoners to list some ways that America isn't perfect. Given that they'd already admitted that America's not perfect, it seems a logical step and a consistent with their view to start to list some of those ways. The Chinese then read out those ways on the camp radio, together with the prisoner's name, making the commitment public. They would also run competitions with small prizes for essay writing, and they'd award winners to prisoners who just bent their views slightly to communist philosophies. Again, these were read out on the camp radio with the prisoner's name. This strategy was so effective that what we actually found was that returning POWs, those who returned to America after the war, were often more sympathetic to communism than the general population in the US, despite being held prisoner by a communist regime. The issue when it comes to investing is that making a public statement can prevent us from changing our minds about an investment when the facts change. Given that, how pervasive and how powerful it is, it's actually very hard to overcome this. Indeed, most of these problems are difficult to overcome. However, I think there are some ways, I think there are some solutions to this and practical ways we can become better stock researchers and avoid these biases. The first solution I think we can do is we can decide in advance what information matters. So you can choose what's important to your investment thesis and what information might be nice to know, but is more likely to add to your overconfidence than your accuracy. An example here I give from assessing the quality of management. So some things that don't appear to matter is that Dan Rasmussen from Verdad Cap looked at whether CEO education or a history of successes mattered when a CEO moved companies. And he found that it had no predictive power. Superstar CEOs at previous companies were no more likely to be superstar CEOs in a new company than other managers. However, we turn to another Dan Davies, in his book Lying for Money, to find out that if a CEO has a history of frauds or failures, then they're more likely to commit fraud or manage a failure in the future. So knowing in advance that somebody being a superstar CEO is unlikely to matter, but not having previously managed a fraud is likely to matter, we can adjust our research to focus on those things that matter most. So we would focus on management quality in terms of honesty, doing what they say, no red flags, rather than being a superstar manager in a previous company. And this suggests that having an investing checklist would also be wise, since this improves your discipline and gives you the discipline to focus on what really matters. The second thing we can do, and it is probably somewhere we can use a checklist to improve ourselves as well, is that we don't waste time on what we think is unknowable. So Warren Buffett famously said, "I don't pay attention to what economists say, frankly." And Buffett chooses not to focus on the macroeconomic outlook, not because it isn't important. I'm sure he recognizes it is important to the outcome of stock returns, but he chooses not to focus on it because he considers it to be unknowable. And if you are happy to accept that there's some things that you don't know and put those outside your circle of knowledge, you don't waste time debating these or spending a lot of time researching these. You save your time for things that are more important. Just an example from UK small cap market here. Some of you may know a company called Zytronic. So they make touchscreens. And the question here is, in the long term, over the next, say, 5 years, is the adaptations we're making for COVID-19, is that going to lead to greater or lesser touchscreen use? And simply, any argument I make that touchscreen use will increase, I can equally make an argument that touchscreen use will decrease. Maybe people won't want to touch touchscreens anymore, but equally people don't want to touch buttons, and touchscreens are easier to clean than buttons. So, either way you look at it, it's very easy to make an argument either way. But in reality, I don't know. It could be either. So what instead I focus on what I do know about the company. And in this case, Cytronic appears to be a deep value investment. It has 12.4 million of cash. It has a net working capital of about 4.6 million. It has land and freehold property of 2.8 million. And over the last 10 years, it's generated on average about 3 million free cash flow each year. And today, today's Saturday, but in the recent past, you've been able to buy this company for about a market cap of about 17 million pounds. This, of course, doesn't guarantee that it's a good investment, but when you're researching this stock, you are, in my opinion, better to focus on, are the management honest? Do they have a tendency to return cash to shareholders, excess cash to shareholders? Do they have a record of not doing daft acquisitions or wasting shareholders' money? What is the culture of the business? Then you are focusing on more unknowable things like where a touchscreen is going to go in the next 5 years. If the market cap was much higher and this was a growth company, you would probably be more interested in those sort of growth factors. But as a deep value investment, other factors matter much more. And I don't need to know, or I don't have to have an opinion on touchscreen use, or particularly what COVID-19 will do to touchscreen use. So that's solution 2. Solution 3 is about how to overcome that information order bias. It makes sense to intentionally order the information you read so that you place greater weight on the factors that matter most. I like Irving Kahn, so legendary value investor Irving Kahn. His advice for reading annual reports was that you should start at the back where you tend to get the key financial information. And this is something I adhere to. So when I'm reading an annual report, I start with the balance sheet. How strong is that balance sheet? I believe Paul Scott often jokes that if a company says that it has a strong balance sheet in its management commentary, it often doesn't have a strong balance sheet. You should check that out yourself. And if I find that a company doesn't have a strong enough balance sheet for me to invest, I immediately move on. I don't waste more time on that company and don't get carried away with any story. I just place it to one side and I focus on companies that have a better balance sheet or more likely to be financially secure in the future. After I've read the balance sheet, I focus on the cash flow statement. So cash is often much harder to fake than earnings, or much harder to manipulate than earnings. So I focus on the cash flow statement. Does the business generate cash? Does it use that cash sensibly? How does it use the cash that it generates? After that, I read the income statement. And then if there is any nuances to those, I read the notes to the accounts. So I look at the notes to the balance sheet, the notes to the cash flow statement, to see if there's anything that can be gleaned from that further analysis, those further details. And after I've done that and formed an opinion, I then read the management commentary. And then I get an idea of the future of the business, where it's going. But that's very much, it's very much tailored by my reading of the figures first, because I consider those the most important information. Finally, I think we should be very careful about making public statements. Knowing the power that that this has, that public statements have, we saw what it could do to the American POWs in the Chinese camps. It's going to make us very hard to change our minds if we make very definite public statements like this stock is going to double. That aligns our identity as somebody who's bullish about the stock. And once our identity is aligned to these things, it's very hard to change. If we make more nuanced statements like, if sales can keep growing at historical rates and margins increase to industry averages, this company is significantly undervalued. If we make that statement and we find that the sales are not increasing or the margins are not increasing, then it gives us the escape hatch to change our mind and say, actually, this isn't, this company is not as good an investment as I thought it was previously. Finally, in this presentation, I'm going to take you through some of what I've called the objectivity warning signs. So these are signs that you might be less objective than you'd like to be about a stock. And I got a good question yesterday that sadly I didn't have a chance to address in the webinar, which was about evidence for objective versus subjective factors for research. So let me be clear here. Although I'm saying these are objectivity warning signs, I'm not saying that objective measures of research such as price earnings ratios or cash flow is necessarily more important than subjective measures like management quality. What I'm saying here is that these are signs that you may be less rational than you want to be when it comes to a particular stock. So the first warning sign I have is that if other investors have started to associate your name or your Twitter handle with a specific stock, this probably means you've become the champion or the person with the most knowledge about this particular stock. I remember back in the Motley Fool days, there's a great poster called Empty End who wrote a great post and knew everything about a company called Socco International, and which is now called Pharos Energy. And he genuinely did know a lot about the company, and the company did very well for a period. However, in the last 5 years, the company's done very poorly. You only have to look at the stock price chart to see where it's gone. But as far as I know, this poster still posts about this company and still holds the shares. They've so aligned their identity as the expert in this company, I don't think they'll ever be willing to sell it. Their identity is too wrapped up in that particular stock. The second warning sign, I think, is if you've joined a private Twitter or Discord group for a specific stock. Now, I, with some friends, run a Discord chat group. I'm active on Twitter. It's not the medium themselves that are issues. The issue is that you've joined something which is only talking about one stock. If you think that group is going to be objective, then I suggest you join and try posting negative articles or bear cases about that particular stock and see how long you last in that group. I think there's a high chance that you might be asked to leave in reality. Similarly, if you've built a relationship or play golf with the CEO, socialize with them, you're probably not going to be as objective as you want to be. And there's nothing wrong with that, of being sociable and meeting people. We love meeting people, attending Mello, meeting management. But there comes a point where if you have too close a relationship to your investor, the management of your investee companies, you're unlikely to ever be able to sell them. I think you have to be careful if you claim you're an industry expert as well, or you are an industry expert, because that might cloud your judgment. You may put greater weight on your own expertise than pertinent factors that other people raise. I remember an example of a company that turned out to be a fraud, where somebody was saying, well, I don't think it's a fraud because I'm an industry expert. And a lot of people pointed out that there were serious questions over the accounts, but this person maintained that their industry expertise overcame or was more valuable than that particular analysis. And in the end, it turned out that it was a fraud, and anybody who held that company lost all of their money. The final warning sign, I think, is if you potentially put your holdings in your Twitter bio or do something similar. Again, we all like to discuss our stocks, and it can open up some interesting conversations. But the reason it's so dangerous as put it into your biography is that you're aligning your identity with those stocks. You're saying, owning these stocks is part of who I am. It's who I am in my Twitter, in the Twitter sphere, and the what you put forward to other people. And that can be quite dangerous. Once your identity is aligned with those stocks, again, it can be very hard to change your mind and sell. Just before I take some questions, a very quick summary. So I think we're less rational than we think we are when it comes to our stock analysis. More information is not always better, and how you conduct your stock research really matters. Hopefully, this presentation has given you some ideas to structure how you conduct your stock analysis, so that you can obtain the key information, and you also have the power to ignore those misleading distractions. And finally, really watch out for those objectivity warning signs. We all suffer them, and we all fall for them from time to time. So again, checking yourself regularly that you haven't become unobjective, you haven't lost your rationality when it comes to some of your favorite stock holdings is worth doing. With that, I think we'll take some questions. Just before we do that, quick promo for my book. If you enjoyed learning about how you can work with your brain, not against it, when conducting stock research, then my book, Excellent Investing, does the same for building a portfolio. So you can obviously get one from Amazon. Please do check out the reviews on Amazon and see see what you think. If you've bought a copy, also please do leave me a review. That would be great. I'm very appreciative of all reviews and feedback I receive from readers. And with that, let me see if I can pick out any questions. Okay, so somebody says, what sort of kind of portfolio turnover do you have? My portfolio is often a selection of deep value investments, and therefore I'm usually not looking to hold stocks for 10 or 20 years. Sometimes I end up, stocks that are doing well or take time to turn around, I will often hold for significant periods of time. I've held stocks over probably 5 years at least, but some I will hold for a few months. For me, it's all about portfolio weighting. So it's about having the right number of stocks and the right amount in each stock. And again, my book takes you through ways you can do that sort of thing better. Somebody also has come in and said, how long do you spend on researching each stock? Well, again, it can vary for me. Something that is a very deep value investment, so something, I can spend maybe only a few hours researching. If I'm looking at something that has, a discount to tangible book value, or even a big discount to cash, for example, during a market crash or a market sell-off, I might just check that I believe the management are honest and the business is a valid business, and that 1 or 2 hours means that I would kind of buy the stock. Equally, I something that's more complex, I might spend a lot of time over, and something where the value case is more nuanced, again, I will do that. The next question says, do you build your own models? Yes, I often have a model for all my holdings, which has some form of analysis of the accounts, and some form of assumptions about future performance of the business. Now, I don't think those models are likely to be correct. I'm not saying that the model gives you the, it is going to be the truth, but the value of the model is in allowing you to understand the real drivers of that business. So going through that process, I type the figures into Excel or Google Sheets myself. That gives me the, hopefully the ability to be objective about them, but also the ability to see, well, what are the real drivers of profit and cash flow and valuation in this business, and how can I find something that's undervalued on that basis? Somebody says, do you do a formal write-up? So no, I don't usually. I will, as I say, the model often gives me the key information, and I regularly review that, particularly if there's something which has, say, commodity pricing. I think one of an investment I've held in the past, but I don't at the moment, is called Sylvania Platinum. And obviously Platinum has been, and Platinum Group Metals has been, a very volatile sector because the commodity pricing is quite volatile. So the investment case for that stock can change quite rapidly depending on the pricing of the underlying the underlying metal. So therefore, doing a specific write-up, probably doesn't give me a lot of value. The writer, the more important thing is to maintain the model and have the model. If that doesn't mean I don't write stocks up, because myself and a couple of friends have a Discord channel called Small Caps Live, where we discuss various investment opportunities and news. So we will often do some research and post some research on those stocks, but it's not a formal write-up. It's something to encourage discussion and discourage. What I actually want people to do is come in and say, no, you're wrong, and here are the reasons you're wrong, because that for me is what adds value. If I have a view on a stock that's positive and somebody comes in and says, no, you've missed this, this, and this, and this is why this is a bad investment, then that to me is much more valuable than everybody agreeing with me or liking a post. Somebody says, oh, how many holdings do you have? How concentrated? So one of the risks of overconfidence, I believe, is that investors often hold too few stocks. So I'm quite careful to have maximum portfolio limits. So I won't have more than a certain percentage in a stock. And that leads to a certain level of diversification. I think typically my holdings would be around 30 positions, of which probably 10 make up the biggest, make up the 50% of the portfolio. So for most funds, or if I was running a fund, that would be quite a concentrated portfolio. For maybe some private investors, maybe not as concentrated. But I think I've got a YouTube channel. So if you look for Excellent Investing, I've done a talk called Diversification, and that can take you through some of the considerations as to how diversified you should be. Hopefully, that will be useful for investors as well. Do you look at quality or momentum? So I don't tend to look at momentum. Again, in my book, I talk about different personality styles and how personality styles fit. And my personality is really that of a value investor. I'm happy to go against the crowd. I'm happy to average down, but I'm fully aware that for a lot of investors, that's, they don't have the psychology that fits, or, the personality that fits with that type of investing. So personally, I wouldn't tend to look at growth or momentum. Obviously, I would love to have a high quality stock, but quality but at the right price, I think, is the most important thing for me. So, value trumps quality, unless it's good value as well. Next one, selling is always a challenge. What advice can you offer to sell well? So I particularly like to have, I trim because I have upper portfolio limits. I don't want to become overconfident and have too much in an individual stock. And also I tend to have a level at which I consider something's fully priced. So as something goes up, I will reduce in price, and then I will sell. Also, I aim to sell if the investment case changes, but I suffer from these biases as much as anybody else. So therefore, for me, that selling, changing my mind and selling is still a challenge, and I work hard to try and be better at that by overcoming these behavioral biases. Could you give a few favorite stocks, or using methodology, have you unearthed stocks which everyone else has written off? Yeah, I guess I can talk about a sort of recent win for me. Was buying into a company called XAR, XAR, that make industrial print heads, and at the lowest point they were selling for about, for less than 20 pence per share. They're a company that's continuously failed. In fact, I think they potentially at one time were in the FTSE 250, and now they're a microcap stock. It kind of shows how far they've fallen. Sort of I bought some of those sub 20p because they were trading as what's called a net. So again, it's trading at a discount to cash and working capital. And they had a new management which were turning things around. They closed a business that was loss making. There was real transformation happening to that. And at the moment, the stock is probably mid 50s. So again, that's not a recommendation. That's just an interesting one where and one I probably didn't do a massive amount of research on, because the most important things were screaming out that this stock has been sold off too cheaply. Whether I'll hold that for long term kind of remains to be seen. It now is my job to do more research on the potential future aspects of that stock. Whereas when it was sub 20p, the most important thing was how much cash it had, what the cash burn wasn't too large, and that they'd shut down their major loss-making ventures. Hopefully that gives a flavor for something that we're doing less research, but doing the right research can be profitable. Obviously, it requires good timing on that. Stock portfolios. Somebody saying what stock screening platforms. So I personally use Stockopedia. I find the one pager particularly useful. Again, it's about, well, what is the most important information? So looking at that, looking at one pager gives me a feel for, is this the sort of company I want to research more? And there's some great companies, and maybe I'll miss them because they're on 10 times sales and they've been loss making for 5 years. I don't always get it right, and I'm sure I will miss some great companies. But because I know I'm a sucker for falling for these stories, I often decide not to even attend presentations for companies that are just have poor stock reports, or have stock reports where I just couldn't see myself investing. And that's not again to say other people shouldn't attend them. I think I love what Mello does, and I love hearing from great companies and from company management. But personally, I know I'm a sucker. I know I get sucked into the story, and I buy something that maybe isn't as good as the management story shows. So one of my disciplines is actually to be careful about the presentations I attend. So do some work first. So somebody says, do you have any plans to write another investing book? So at the moment, I'm working on a value investing book. So my book, Excellent Investing, is applicable to all investors. I've written it as a general book for everybody to learn more about portfolio management. But my real passion is these kind of value investment scenarios. So my next book will be really focusing on those, and hopefully going into more depth on that particular topic, which is pretty close to my heart. Okay, so somebody says, what single point of understanding of psychology has improved your investment performance? So this is a good one, just because it comes to the heart of why I wrote the book. Is when I first started investing, sort of early 2000s, then I read loads of books about these behavioral biases, but they didn't really do anything to change my investing. I knew a lot more, but I still made the same mistakes. I was still overconfident. I was still kind of all of these made all of these mistakes. And because of that, this kind of led me on the journey to really look into this more. And what I came across was there's a guy who is called Daniel Kahneman, and he's sort of the father of behavioral psychology. He won the Nobel Prize for his work with a guy called Amos Tversky, who would have also won the Nobel Prize if he hadn't died. And they asked Daniel Kahneman, what has all your research made you a better decision maker? And his answer was, no, I've just become better at finding the mistakes in other people. And I think for me, this is the key. This is the key point: is that just trying harder, knowing the behavioral biases and trying harder doesn't remove the behavioral bias from you. In fact, probably everybody else can see this behavioral bias in you, and you can't see it. Everybody else is going, Mark loves that stock too much, I don't get it, he's fallen in love with the management, and you're going, oh, I'm perfectly rational, I've done a lot of work on this, and therefore I'm the expert. And it's that that understanding that we are our own worst assessor of objectivity, which makes me probably improved me most. So that's led me to try and take on board when people are critical of my investment theses. And it's also led to me putting in place rules for my portfolio, like upper portfolio limits, target weightings, selling if I lose confidence in the management, hiding my profit and loss so I don't become loss averse and focus on individual profit and loss on individual investments. There's lots of rules that have come in, but at the heart is the understanding that I need these rules. I need these these ways of controlling my own behavioral biases. And it means I get it wrong sometimes. I'm willing to accept that I sometimes I sell and the stock goes up, the stock doubles, or sometimes I just make a make a mistake, and because I obeyed the rule and it wasn't the right thing. But in my experience, You know, almost every time I've tried to bend the rule and I've said, oh, my rule says this, but, you know, I think this stock is really great, so I'm going to hold more than my portfolio limit in it, then that's usually a sign that the stock is going to do badly in the future. You know, I think almost every time I've overwritten my own rules, I've made a mistake by doing that. And that's the reality. Right, I think that's time. I'm going to leave it there. So thank you very much for everybody joining. Thank you very much for the comments and questions. Yeah, do feel free to contact me on Twitter, or to reach out if you've got, you know, and join us on Small Caps Live as well, and join the discussion there. Thank you very much, and over to Anne, I think, again.